We recently sold my grandmother's house after her death, which was left half to my aunt and half to me and my siblings. Due to the time between her death and the date of the sale of the property, there was a rise in value. After taking into account a legacy also left to us, each of the 4 grandchildren own 14% of the property, while my aunt owned 44%. There was a capital gain of £10,500 each on the 14% stake owned by the grandchildren, which is below the annual capital gains tax allowance threshold of £11,300. Do we still have to make a capital gains tax declaration to HMRC? Heather Rogers of Aston Accountancy replies, the rules are that, if an asset which would be chargeable to capital gains tax is sold, then if the value of the asset disposed of is over £44,400, then you need to make a declaration to HMRC. From your enquiry, you have stated that the gain which was made on the grandchildren's share is £42,000, split between the 4 grandchildren, equating to £10,500 each. However, the value of your share of the actual property, I suspect, would exceed the £44,400, and I would therefore most certainly recommend that you reported this to HMRC, even though you do not have any capital gains tax to pay. The other thing you need to bear in mind is that, when a house is sold, HMRC are aware, as they work closely with the Land Registry. Therefore, if a property is sold which would be expected to give rise to a capital gain and a tax return is not made, even if no tax is due, then it can prompt an enquiry. Therefore, my recommendation is that all 4 grandchildren should include this on their self-assessment tax returns. If they do not currently complete a self-assessment tax return, then I would suggest that they contact HMRC, and the details are below. This can be quite a frustrating process, as HMRC are so slow to respond. However, if they contact HMRC, then they can obtain a ruling from them as to whether they are happy for them not to complete a tax return in their particular circumstances. You can call the Capital Gains Tax Helpline on 0843 455 0092 or write to Capital Gains Tax Queries, HM Revenue and Customs, BX91AS. With regards to your aunt, she would be in a slightly different position from the grandchildren, unless the property was her main residence, in that she was living there with your grandmother. She would certainly need to complete a tax return, as her share would qualify on all counts. However, if you had spent any money improving the property following a cent to the beneficiaries from the will, then this could be offset to reduce any capital gains tax that may be payable by your aunt. How to avoid inheritance tax, and should it be cut? The Chancellor asked for ideas for inheritance tax to be simplified, but should we even have one at all? Some who argue against it say that taxing someone when they are alive, and then their estate, when they die, amounts to double taxation. In contrast, others argue for a lower inheritance tax-free threshold and an even higher tax rate than the current 40%. We look at how it works, why it is so unpopular, and how you can avoid it. Press play to listen to the show below, or listen, and please subscribe if you like the podcast at iTunes, Acast, and Audioboom, or visit our This Is Money podcast page.